Hey, inspired moneymaker. Artificial intelligence and machine learning are rapidly changing our world. But what does that mean for our money? Episode 255 features Robert Nestor, CEO of Qraft Technologies USA.
Decumulation is a riskier period than accumulation. We have a lot of opportunities if we make mistakes in the accumulation phase, right? We can work longer, we can save more, we can recover from a major market calamity or a major life change. In decumulation, that's harder to recover from. And I think a lot of investors will need more responsive strategies, more responsive approaches from their advisor and from their investment portfolio. And I think AI is going to be at the center of that.
I'm Andy Wong, host of the Inspired Money Podcast, and I want you to improve your money mindset. Let's get inspired together so we can do better with our money and make a bigger impact in the world. This episode of Inspired Money is brought to you by Seeking Alpha Premium. If you're a DIY investor, Seeking Alpha can be helpful because of its proprietary quant ratings. You can quickly and easily connect your brokerage account, and you'll immediately get ratings from strong sell, hold, and buy to strong buy for all of your holdings. Ranking your stocks systematically gives you a snapshot into what's acting well and what stocks you might consider selling. You can get a free trial by going to the link inspiredmoney.fm/alpha. That's inspiredmoney.fm/ALPHA. I have an exclusive offer for you. $99 for a 1-year subscription. That's 58% off regular price. Try it out and let me know what you think. I hope it can help you to manage your investments better, and your subscription will help support the Inspired Money Podcast. Today's guest is Rob Nestor. He's a financial services veteran with experience in products, strategy, and exchange-traded funds. He believes that artificial intelligence will revolutionize money management from AI-powered ETFs to AI trade execution. In this episode, you'll learn about how AI can complement human intuition to better generate returns with less risk, the impact that AI could have on fees and expenses, and stay tuned to the end to hear how AI could help investors entering the decumulation stage, those who need to control risk. Now let's get inspired with Rob Nestor. Rob, welcome to Inspired Money. I'm so excited to have you on the show.
Thanks for having me, Andy. I'm looking forward to it.
Let's jump right in. What's your earliest childhood memory of money?
Earliest childhood memory of money. Well, I guess my earliest childhood memory is my first paper route, in the sense that, my dad suggested, I think I was 11 or 12, my dad suggested that, why don't you get a paper route? And I would say, why? Why would I need that? It's like, well, you can buy some of the things you want instead of, a lot of the things that we as your parents determine. So I think that was probably the earliest thing that occurred to me. But I would say the most profound moment, Andy, was when I was 17, my father lost his job at that point. I was a year away from college. And I began to really sort of understand and wonder where was money coming from? Where was, how would I provide for myself over time? What did that really all mean? And so I remember that being very profound for me and sort of thinking through, like, I've got to really have a plan. And what does that plan look like? And the plan involved, money and saving.
So did that draw you towards financial services and investing?
I think it did. I went into college a year later, majored in economics, and I got a very much, a sense of numbers and discovered what I really liked. I'm a logical guy in general, but I wouldn't say I had a really deep understanding of investment until, my first job. I went to work for Vanguard right out of college in an investment accounting role. And it really all started to click for me. Not just from an accounting sense, but I got to work with the investment managers really closely. I understood what they were doing, what investing truly meant. And that set me on my way because I was convinced, probably 6 months into that job, this is my future. I'm not so sure I was convinced of that when I took the job, but definitely 6 months in. I was ready to go. That's where I wanted to be.
I think we must have had somewhat similar starts in the business because I think while you were at Vanguard, you were very much involved in the Asian financial crisis.
That's right. Yeah, that. Actually, I cite that, Andy, as probably, I always think about careers as a combination of perspiration as well as sort of serendipitous moments, opportunities where you have to plunge through. And so for me, that first one was the Asian crisis of the late 90s. I was a, senior manager over international accounting at Vanguard, mid-office job. Nobody knew me at Vanguard. Overnight, I was in the chairman of Vanguard's office making recommendations on how to value the Thai baht and the Malaysian ringgit in the teeth of the crisis. And literally that went away. And 2 weeks later, I got a call from the head of investment product development saying, the chairman thinks you should come up and run product development. So come on up. And it was just that really set my career.
Wow. Rob, I've heard you say that ETFs have been the most impactful evolution in asset management in a generation. Can you talk about how that core belief shaped your career?
Yeah, so I would actually say indexing and as accelerated by ETFs has been the most impactful of a generation. So I very early came to realize, the realities, which obviously many have over the last, particularly 15 years, and how hard alpha is and how hard it is to outperform. And that many strategies, many approaches do not make a lot of sense, particularly if they are higher cost. The power of passive, which a lot of people, don't recognize, I think for me is very much in the cost equation, and that reality that driving down cost, for investors is critically important, and the shaping of investors' profiles in terms of what are they trying to accomplish in their portfolio should be at its core, I think, low cost across the board. But that doesn't mean you have to be 100% passive. That means you have to be sort of very cognizant of what you can control and recognize the trade-offs. Hope springs eternal. Even the most, the strongest advocates of indexing, I think I'm one of them, still try to outperform. And there's absolutely nothing wrong with that. But it became very sort of foundational, the cost aspect of passive investing, to how I thought about the world going through it. And ETFs really just accelerated that reality over the last decade.
Was leaving Vanguard a difficult decision? I mean, in retrospect, looking back, you went to BlackRock, you went to Direxion, and I think that those were good bets since ETFs have just ballooned in asset size. But was that a scary decision for you?
I was very scared. I thought I was going to work for Vanguard all my life. I fundamentally believed in the principles of the business and the foundation of business, not just indexing and passive, which was core, but really, low cost and client ownership, and that was a very big one. But quite frankly, when I left Vanguard, so I launched Vanguard's first ETF, and as I was running global product development. Then I went on to other roles within the company, which is pretty common at Vanguard. But I didn't feel like the company was fully committed to ETFs at that point. I fully believed it was more of a hobby than a conviction for them. And since obviously that's changed quite dramatically over the last 15 years since I left there. But yes, it was a very, very hard decision. But it was actually Barclays Global Investors at that time that I went to, and they were 2 years later acquired by BlackRock. But the chance to focus specifically a lot of my career around ETFs was just too much of an opportunity to turn away from.
So as ETFs grew in asset size, like exponentially, where was your focus? It was on the product side?
So I've been blessed to be able to work across, the functional leadership role. So yes, I mean, in my DNA, Andy, I'm a product guy and I'm an enterprise strategy guy. And that's where I've spent most of my time. But I spent time in other areas. I ran product marketing for BlackRock. I also had a marketing stint at Vanguard. I ran distribution strategy. I've been pretty much in functional leadership roles across the asset management business. The only thing I've never done is I've never actually run trading. But at its heart, I'm a product guy, and anyone who knows me in the industry, recognizes that. I love the product design aspects of this business.
So moving from passive investing to AI-driven active management, that seems like a pretty big move. I did notice that Elon Musk recently said that passive investing has gone too far. And Kathy Wood, founder of ARK Investment Management, she said, history will deem the accelerated shift toward passive funds during the last 20 years as a massive misallocation of capital. Where do you fall in the active versus passive debate?
Yeah, I've had so many debates about this, Andy. I don't think it's active versus passive, just like I don't think AI is man versus machine. I think it's active and passive. It just comes down to what you want to do, what you're trying to accomplish as a portfolio construction matter, and as an investment objective matter. So I think it's really important, as I mentioned earlier, to maintain the cost equation and understand what you're trying to do. The reason why I got involved with AI were a couple of reasons. I think that obviously artificial intelligence has changed our world. Whether it's healthcare diagnostics, whether it's advertising, and we're able to follow us on our phones, or whether it's Google Maps, which we can't seem now to live without. All AI power driven functions. And I think it's inevitable that artificial intelligence will play a much, much bigger role in asset management. Today, it's largely played a role in trading for quite a while, actually. And it's also in playing an increasingly impactful role in the operations of delivering advice and guidance. It's making advisors operationally much, much more efficient in identifying potential issues with their clients, activities with their clients, and making advisors much more efficient operationally. But it really hasn't played that significant a role in the actual investment decisions being made very directly, whether it's at the security selection level or whether it's at the asset allocation level. I believe it's inevitable that it's going to not fundamentally replace what's happening today from active managers, but dramatically augment how we deliver exposures and specifically how we try to source alpha in the industry. And Qraft is all about being at that intersection, and that's where we want to go.
So tell us how you got involved in Qraft Technology. I think it's a Korean-based company.
It is. Korean headquartered company, started about 6 years ago, and frankly built out of the original founder, Marcus Kim, and the others that came along were on sort of the trading side of the world, and began to get frustrated by the realities that so many areas of that were inefficient or short-lived in their efficacy. And he studied artificial intelligence quite deeply, was able to add value, and founded a firm based on that. But pretty quickly, the firm evolved beyond trading. We deliver trading insights as part of our business, but pretty quickly evolved into security selection and asset allocation, top-down capital markets-based decisions. So, but all Asia-based, and built a small but rapidly growing business. About a year ago, simultaneously to engaging SoftBank for potential capital infusion in the business, a former colleague of mine who became one of the principals in Qraft reached out to me and asked me first to just be a sounding board for the business, given my background across asset management over 30 years, and then more formally as a consultant in the business as we started evolving those discussions quite rapidly with SoftBank. And then when we secured the capital investment, I was asked to come aboard and launch a proper U.S. asset manager leading with AI. And so I'm employee number one as of January 1st, and here I am. And Andy, I will say that right at the same time that I was asked to do that, I had another job offer that was the more standard sort of ETF fare. And I decided to take the road less traveled. I had been fairly conservative as it relates to my role. I work for the world's two largest asset managers, which are pretty safe places as it goes from a business continuity standpoint. And I'm not a technophile or a technologist, but the technology and the opportunity fascinated me, and I was absolutely convinced, much like I was convinced that ETFs were going to change investing 20 years ago. I was absolutely convinced that it's just a matter of time before artificial intelligence plays a bigger role. And so I leaped at the opportunity to do something less safe, but far more interesting, and here I am.
Rob, where is AI asset management today, and what's the vision for what you think it can become?
Yep. So I frequently, I'm a big fan of analogies. So people often use the baseball analogy. We're in the, top of the second inning or the bottom of the fourth inning in the Everest. I frequently say where the leadoff hitter is still in the batter's box in the case of where AI. It is very, very early days in terms of driving investment decisions like it. While we have, a nice little business in Korea and the early stages of a growing business in the U.S., we have to do a lot of things. First, we have to tell the world about who Qraft is, what our capabilities are. But most importantly, and more importantly, we need to be able to really articulate what it means to use artificial intelligence as part of an investment decision-making process. So we are very, very focused in the U.S. on delivering at two primary levels. I mentioned the trading insights that we deliver in Korea, but right now that's solely in Asia. We're working on that for the U.S. But what we are primarily focused on now is delivering investment strategies at both the sort of top-down asset allocation level, the capital markets assumptions through our proprietary AI models, largely through portfolios of ETFs, and delivering that to platforms, some RIAs that want to do something on a more customized basis that believe in the power of AI. And then on a bottoms-up level, we're doing it security selection level, so building portfolios as most people sort of understand in picking individual securities and constructing holistic portfolios around that specific goal. And that manifests itself today in the 4 ETFs that we have listed on the New York Stock Exchange, some more coming later this year, as well as a couple of customized portfolios that we do for certain entities.
Can you elaborate a little bit what the, portfolio selection process looks like when you're applying AI versus a quantitative trading strategy?
Yeah, the comparison to traditional quantitative strategies are frequent for us. A lot of people say, "Isn't this just quant? Is this just quant on steroids?" And quant's been around for decades, right? Investment decisions have been made on that basis for a very long time. The fundamental difference at the top line is that quantitative strategies are still human determined at the outset, right? So in the simplest of terms, I believe stocks with the following attributes will outperform. So so there's some human hypothesis that starts with. So let's quantitatively prove out, seek stocks that have these characteristics, prove or prove false that hypothesis, but it's heads down a single path determined by a human, even if it's using large big data processes, which is part of artificial intelligence. Our sort of approach is to not start with a single path, and most artificial intelligence processes try to accomplish it. Rather than starting with a hypothesis that is attempting to be approved or disproved, instead it looks to harness massive data sets and determine within those data sets what is probabilistically driving return that can be done at a much, much greater scale than traditional quantitative processes that are still subject to human bias and generally head down one path. Now those lines blur, Andy, a little bit because even some quantitative processes are using some elements of big data, some natural language processing. But the fundamental difference in traditional quant is it generally starts with a human hypothesis. AI, as its evolution, it doesn't start with that. It starts with rich, very large data sets, and data factors when iteratively applied can range in the billions and the trillions. The reality is 99% of that data is more than that. 99.9 tenths of that data has no deterministic value in terms of future return. What AI is about is taking those massive sets and finding the very small, very, very small subset of drivers of return and highlighting them, raising them, and building portfolios in that regard, but still overseen by humans.
So tell us a little bit about how can AI improve upon traditional fundamental analysis in selecting individual securities?
Yeah, so it's as I said this a little bit earlier. I think it's about man and machine. So fundamental processes still have a lot of value, and human intuition that's applied in those fundamental processes still has value. Human intuition is very, very powerful, and AI processes are not trying to displace it. They're trying to leverage it at a scope, scale, and speed that a human alone could never accomplish. So it's really about sort of complementing a lot of that sort of intuition that goes into a lot of the fundamental analysis, but doing so at a scale that a human could never do alone. And that's what it's all about. So it's man and machine, not man versus machine.
Okay, so at your ETFs, is there still a portfolio manager overseeing the strategy?
There is, but not operating in the traditional way that a portfolio manager and most fundamental processes do. So the portfolio manager of our portfolios is steeped in AI applications. So there's generally sort of a co-management function. Someone who is steeped in sort of purely in the investment principles that we commonly understand, aligned with an AI engineer that looks to sort of harness that massive data set, surface the drivers of return, and then that is analyzed to see is there intuition behind what has been surfaced, or is it just a statistical factoid that is not predictive in any way? So the difference between stocks beginning with the letter P outperformed over the last three months. There's no intuition behind that, right? But there is intuition, or we try to apply or evaluate the intuition when the AI surfaces a driver of return that has been sort of very predictive, that is not commonly, surfaced. It could be, common fundamental drivers that we understand, just applied in a different way. It can be other things like web traffic to a specific part of the internet, and greater interest in products as a result of that. It could be a variety of things, and so yes, the human is there to sort of apply some of the intuition against what the AI has surfaced.
Do you think that changes over time? If we use the analogy like someone who has a Tesla auto steering car, and the car really doesn't want the person to take their hands off the wheel. It's more as a technology assist. But I think the expectation is eventually we will have self-driving cars where you can read the newspaper or maybe an iPad, that you don't have to pay attention at all. Do you think there will be an evolution on the asset management side?
I'm not sure, and I've always been like the first person to say never, but I highly doubt that AI will completely and utterly take the human out of the equation. Even the self-driving thing, I think obviously self-driving is going to become bigger and bigger, but I think there's going to be a subset that still want control. And in the same, maybe that's not the greatest analogy, but I still think there will be a need for traditional human judgment and monitoring of the machines and that intuition to come into play. And so I don't think it completely replaces the human in the alpha search, but I do think it probably displaces many of the humans aggregately in the alpha search and really sort of changes, over time, sort of the focus of what the human's role is in that set. But I don't think it completely removes it.
It sounds like you kind of see a hybrid approach, some passive investments, some active investments enhanced by AI, just as diversification. In your sort of longer term vision, do you see not only individuals but institutions really getting on board to active management powered by AI?
I do, and it's happening in small pockets. A lot of it's behind the scenes, but it's happening in small pockets in a variety of different areas. Many of the bigger firms are already spending a lot of time on this, but they're doing it behind the scenes. They haven't really, they're not really outwardly focused on this. And there's a lot of firms like us in sort of early stages that bring a deep, rich artificial intelligence background that are sort of trying to move the dial at the sort of early stage grassroots level. Andy, a lot of people ask me like, what's the, fundamental differentiating factor of Qraft AI application versus someone else? Well, first, it's a little bit hard question to answer because unless we see somebody else's code and exactly what they're doing, a lot of this is I don't run from the word black box, but it's highly proprietary in its application. Most AI folks are using, machine learning, deep learning, and similar techniques, but the actual application is still very, very proprietary. But I think it's going to have profound impacts on the search for alpha over the next generation, particularly over the sort of next 10 years. And I think there's room for a lot of success stories here. And there's the only thing I think holding it back, Andy, is the reality. A lot of people don't understand what it is and what is actually happening. And we need more than, I'm a believer there's plenty of room for success. We need more than Qraft to tell that story. And I think we are probably on the cusp of a lot more organizations beginning to tell that story over the next couple of years.
Rob, alpha remains hard. It's a really tough nut to crack. All the, there are hedge fund managers trying to deliver alpha. There are mutual fund managers trying to deliver alpha. With AI, what is the target improvement in performance?
Yeah, so a couple of things. This was beaten into my brain at Vanguard that alpha is still a zero-sum game, and AI doesn't change that dynamic. That's just that. And so, but I do think AI has the opportunity to deliver it in a more consistent basis over time than sort of many of the traditional processes. But it's still going to be a challenge, and no system, AI or otherwise, is going to win, the vast majority of the time. So that sort of as a foundation, the opportunity in terms of like I think your question was more directly, but what's the alpha opportunity? That's still largely framed, I think, by a couple of the basic parameters that everyone's, most and certainly from your seat understand, meaning, what is the underlying asset class and what's the, continuum of that? What is the risk that someone is willing to take the tracking error they're willing to take, and the like. It is certainly a larger equation at the security level, or at the fundamental bottoms up level. Just because it's a richer data set, a much sort of deeper opportunities to identify alpha than sort of top down sort of asset allocation world is. Typically where the alpha continuum is much tighter in terms of the value add. So it's really driven by the strategy. And the asset class that is being focused on in terms of what the opportunity is. I don't think it's necessarily wider or than traditional sort of fundamental processes, but I think it portends the opportunity to deliver it in a more consistent basis, and that's really what we are focused on.
Can you talk about the 4 ETFs that exist today, and talk a little bit about the back testing and the history of the ETFs?
Yep. So the two of the ETFs, QRFT and AMOM, were launched 3 years ago. NVQ and HDIV more recently, and they're mostly built on a factor sort of foundation. So we try to do two things in that regard. We try to build portfolios harvesting traditional, academic factors. So quality, momentum, value, size, and low volatility. But what we attempt to do is add security selection alpha over and above that, on top of that with AI. So the AI works to try to find the go forward sort of, in case of QRFT, which is a multi-factor approach, the optimal combination of factor exposures and factor harvesting, and then add security selection across the gamut. That's a more diversified portfolio that's sort of, broad market focused. AMOM is against the leverages or harnesses, I should say, the momentum factor, and then tries to add on that. It's been a difficult 18 months for momentum as a factor, sort of in general, but it's still ahead of the MSCI momentum factor. And then NVQ focuses on value. The nuance there, though, is that we have attempted very directly to sort of reset, or evolve, I should say. Reset may be too strong. Evolve the concept of value. I mean, there's a lot of debate, as you know, is value dead? Has our world changed? Has technology fundamentally changed our economy? That traditional measures of price to book and value does that really still work in the new world? I'm of the belief that things have changed quite substantially, but I don't think the concept has gone away. But a big part of that, I think, is investors' ability to measure and leverage intangible value, things like brand, that have really evolved to be, a critical part of enterprise value determination. And so I think value needs redefinition, and that's what we're trying to do in NVQ. And then HDIV is trying to harness a relatively high level of dividend flows, but do that through an AI lens.
Is the AI always iterating? And I'm curious because it's like when you set up rules for the computer, we've been in a falling interest rate environment for pretty much my whole career. And suddenly, in recent times, we're seeing a change there. So is there a risk that this time's different, that the AI is not aware of or hasn't been taking into consideration?
Well, so we talk about that concept all the time. In fact, I was just talking with our team yesterday in terms of a lot of the research. If you think about, to your point, we've been basically in an unending rate, decline for the better part of 3 decades, right? I came in, when I first went to work, Vanguard money markets were earning 6.5%. Crazy to think about, right? So it is a very, very fair question to say, and this goes across the board, in terms of determination of of sort of drivers of return that we think can be enduring, including a lot in the factor space, is a lot of that sort of built on an environment that is not likely to happen again or happen again in anytime in the near term. And it's just absolutely crucial that you develop AI processes that consider that, take into that account. It's not foolproof. So how do you do that? You do that with deep, rich data sets that even span before that. And the data is arguably not nearly as rich prior. At least the stock specific data is not really as rich 30 years hence as it is now. So there are AI techniques to try to adjust for that. It's not foolproof. And, I think active managers sort of across the gambit, whether, traditional fundamental, quant, traditional quant or AI, have to be sort of very conscious of that and always learning. But to very directly to your question, it is always learning. You typically build AI processes what's called a training period, or in statistical speak, sort of in sample sort of approaches. And, typically ours span, 15, sometimes 20 years in that regard, as rich as we see the data today. And then typically you have sort of the add a sample, even before you've launched a product or frankly made available to a strategy summit that spans, 7, 10, and, in some cases, some strategies as long as 15 years. That is based on the training for that sort of first 15 years, that training period, but then runs without, human adjustment to that, for the next 10 to 15. But the machine itself is always learning. It's always taking in, new data sets and trying to learn from the recent past, as well as, relying as a foundation on a longer past. So it's active and it's always learning and it's always sort of refining. And we are reviewing, and a human is always sort of reviewing the decisions that the machine is making to make sure there's intuition there. Very long-winded, but that's sort of how it's designed.
Since you came from, since you came from index investing and passive investing with a focus on cost, what do you think the impact on cost will be with AI investing?
I think it inevitably is going to drive. I think it's going to be another area of driving costs down in the alpha function. So we've obviously seen a massive. So the other sort of profound, I think, generational change is just the incredible driving down of cost for the average investor. Right? 25 years ago, it cost you $40 to $50 to buy 100 shares of IBM. Now it's virtually free. Why is that? It's inherently technology. Technology has brought that efficiency, and technology, by the way, has also brought that awareness of investment costs and their impact to investors. I think AI will be a critical part of sort of the next leg of driving costs down across the ecosystem in asset management. And we talked about operations, we talked about trading earlier, and I think that's also going to drive it down in the alpha function. It's going to make the alpha function more efficient, and probably, quite frankly, drive less of a need for people-intensive processes. But it won't completely replace it. But I think it's going to be a core part of the continued movement down of cost in asset management.
So that's good news for the end consumer.
Absolutely. I mean, it has been sort of a Goldilocks environment in a lot of respects for the end investor in terms of the driving down the cost of investing over the last 25 years. And I think this is the next leg.
Since there was a time when you thought that you may spend an entire career at Vanguard, I think there are a lot of end investors who, they want to invest as simply as possible. And you can own like the Vanguard market index, very, very low cost. To somebody who is investing in that style, what do you say to him or her? Why should they consider looking at like an AI enhanced large cap strategy?
Yeah, it comes down to what you're trying to accomplish. So if someone said to me, is investing in the Vanguard, total market portfolio, for the entirety of my equity allocation, a bad decision? And I'd say it depends. What are you trying to do? I don't, if you're just focused on the most efficient participation in the asset markets and it's not really that important to you to try to outperform, or it's not really important to you to manage for risk and other dimensions, and you can stomach the ups and downs that the markets will inevitably bring us, I would say that's a fine solution, as long as that's your assumption, or as long as that's your objective. But if you are trying to add a little bit more, or you want a little more risk responsive, approach to things, then AI, I think, can be a crucial part of that solution. And I think increasingly it will be going forward. And so it always comes back to like, what are you trying to accomplish and what's most important? And AI can play a large part in a big part of that mosaic, but it doesn't necessarily mean it has to be everywhere, or it doesn't necessarily mean a super low cost index approach is a bad answer.
Well, I think looking back, right, with the benefit of hindsight, looking back, passive investing, owning like the total market is great when the market's going up. The downside is when the market's going down. You're not protected. So what kind of risk factors are built into Qraft's AI process? And should investors be then looking, because we don't really have that much history, right? Is it a matter of looking to see how does your ETF perform in a down market?
Well, I think that's one dimension they certainly should go. So, I've said, very, very frequently that, the last 15 years, right, coming out of the great financial crisis, was just a Goldilocks environment for the rise of passive, right? It almost didn't matter where you were invested. It just mattered that you were invested, right? And I think that had a lot to do with it in terms of its rise and people, determining that, maybe it's not worth it to try to outperform, and, I just get a super low cost, portfolio. But I think though the last 6 months, to your point, has been a sort of sobering reality of that risk has not gone away. Stocks can go down, and they can go down in a pronounced way for a period of time. I mean, we learned that a little bit in COVID, but it's not back so quick. I think before people looked, it was back to where it was, and they didn't really. I think by most prognostications, I don't know what yours is, but most people believe that we pretty much massively borrowed forward returns for a long time, and that, reasonable expectation of the next, 10, 15 years is probably mid to high single digit equity returns. And I think, Andy, that a lot of people will not, accept that at its face and come back into active processes across the gamut and consider more responsive processes as it relates to artificial intelligence. I also think there's other dimensions that are going to drive this, including, the rise of ESG, which I think is fundamentally at its foundation a data problem. And data is the fuel of AI, and AI works, very well where data is otherwise so large to be evaluated or ambiguous at its own. So I think that's going to be a tailwind there. And then, we're at and you well know this in your practice, we're at, I think, the cusp of, in the beginning of the big decumulation, right? 10,000 people in the U.S. are turning 65 every day. And as you well know, decumulation is a riskier period than accumulation. We have a lot of opportunities if we make mistakes in the accumulation phase, right? We can work longer, we can save more, we can recover from a major market calamity or a major life change. In decumulation, that's harder to recover from. And I think a lot of investors will need more responsive strategies, more responsive approaches from their advisor and from their investment portfolio. And I think AI is going to be at the center of that. And a lot of sort of what we build in, and again, it depends on what you're trying to accomplish or what the strategy specifically is designed to do. But AI can be sort of very responsive to nearer term signals. And I think people will demand that going forward in a big way.
Can you talk a little bit about ESG, that's environmental, social, and governance investing? Talk a little bit more about the big data challenge. Is it a matter of like multiple disparate data sets, too much data? What is the issue there?
I think yes, and other things. So as a business matter, when I think about asset management, I think ESG and hopefully AI will be the most profound impact on the asset management business over the next 10 years. I think the train is out of the station. I think increasingly investors, want to put their money where them. Not every investor, and maybe, not yet the majority of investors, but I think the movement is unequivocally in that direction, particularly for institutional investors. I think the early solutions in this space, Andy, have been fairly blunt instruments. Really just sort of about participating, in it. And they've been blunt, I think, because people aren't really sure what they want to do. I think it's been blunt because the data is ambiguous and often short-lived at this point. I mean, we really don't have deep data of much more than 10 to 12 years on classic, or what are becoming classic ESG measures. And a lot of what we have is somewhat ambiguous at this stage. So I think all of those things portend a future where solutions get much more precise as investors get much clearer on what it is they want to do and how they want to allocate their capital in this space. And I think the data will get richer, and processes such as artificial intelligence will interpret it more precisely and more directly for what investors are trying to do. So I think there's a very logical intersection there. And I think that's going to play out over the next few years.
It'll be very interesting to see.
Yeah.
We started our conversation, you were saying, that realizing as a child the importance of making money and being an entrepreneur. What has the difference been working at a Vanguard or BlackRock and then moving to a smaller startup?
It's night and day. So, as I said, the large asset managers are really, they're a safe place to work, tremendous amount of resources, great brands in the industry, and the ability to reach investors at a scale that is very, very hard for any small and particularly, a startup to actually replicate. But the other side of that coin is that those organizations have to do many different things in order to grow. The numbers are quite daunting in terms of, and this was at many, this was probably at 20% the assets that they are now. But Jack Brennan used to get up in front of the officers when I was there at Vanguard in the first meeting of the year, and he would say, "Okay, we're $50 billion in the hole in terms of new flows, so we better get started in figuring out where we're going to make that up." And his point was there's natural turnover in the industry and in the book of business, and that we've got to grow in every aspect to just grow the top line. The BlackRocks and Vanguards of the world need to be in 8 or 9 of the 10 battles in the industry, and they've got to win most of them. Well, the benefits of, smaller organizations strictly starts, we can focus on one thing and we can focus on doing it really, really well. And we can be much more sort of dynamic, act quickly, and, really bring a level of sort of cutting out the noise and the bureaucracy that exists at larger organizations. And so those are the fundamental differences. And, at sort of the top line of what we're trying to do. We're focused on one thing, and that is bringing artificial intelligence into investment decision making in this industry, and really nothing else as a business. And that is wonderfully clarifying, but it's also daunting because we're smaller. We're a well-funded small organization, but we're still a small organization nonetheless. And being heard among all those voices is a real challenge, but we embrace it.
Well, it's encouraging to hear that the little guy still has a chance, given the size of the behemoth institutions out there. Because it's trillions, right? It's not billions, it's trillions now.
It's trillions, exactly. It's unbelievable to think about. Yep.
Rob, I like to ask all the Inspired Money guests, how do you define success?
Personal, or are you talking business success?
Oh, how about both?
Okay. So personal success is, to me, feeling like you're making an impact on an organization that's very much, associated with you, that you can take away personally. For me, as CEO of a startup, that is really sort of getting traction in the business and directing the team to rewarding professional careers where they can grow, not just their incomes, but their professional impact. And that is what I enjoy most about this in the startup realm. In terms of business success, and maybe there's a little sort of line back to your question a few moments ago, we don't have to grow in dollar terms. We don't have to grow, even a small fraction of what the big behemoths need to grow to be successful. So I frequently get asked, well, what's the addressable market and what do you focus on? The addressable market is massive. I don't really get caught up with that. What I want to do is slowly but surely change and illuminate the understanding of artificial intelligence. And I think if we do that, Andy, we will get our fair share. Obviously, every startup or early maturation firm has goals and aspirations. You have to, and I'm not dismissing that, but they're very sort of firm specific in that regard. If in 2 to 3 years there's a measurable, much wider understanding of artificial intelligence role in asset management that we have been a part of, I will see that as tremendous business for us, and I'm confident the dollars and cents will come along with it.
We talked about the individual investor and ETFs, how the individuals can participate. How big a portion of your business do you foresee being using Qraft's platform for institutional asset managers?
Yeah, so we the early focus of the business really has been trying to reach, at least in direct terms, professional investors. So what does that mean? That means what most people traditionally think as institutions, pensions, asset managers, foundations, and like. But also, we want to reach wealth and wealth advisors, such as firms like yourself, and platforms that enable that. Custodians and the like. That's where we have focused because we think there's sort of, just as a business matter, greater scale, where you have a sort of little bit more nuanced investment story and understanding. It's more likely to sort of take root there early days. But ultimately, all roads lead back to retail, right? Even, I don't know but every pension fund, everyone's 401k, ultimately that money is for individuals. Every wealth advisor ultimately they're making the investment decisions, but the money ultimately is for the benefit of individuals. And I think over time, they will start to adopt. In terms of asset managers, what you specifically, asked about, I think the largest ones are already working on this today, and probably won't need the benefits of a Qraft and what we bring to the table. In asset management, we're focused on the mid-size and lower areas. Call it, roughly 100 billion and less. Those are the firms that likely are not there yet, probably don't have the wherewithal in the near term to build these capabilities from scratch, and want to partner with firms like Qraft who already bring that expertise to the table and can build portfolios for them or partner on certain developments. So that's certainly what our early evidence suggests.
Well, Rob, thank you for sharing your personal story, your professional story, and Qraft story. Tell the Inspired Money listeners and viewers where they can follow you and learn more.
Well, they can come to our websites, either craftaietfs.com or craftec.com, and learn more about the firm and learn more about our product.
Great. Thanks so much, Rob.
Thanks, Andy. Take care.
So what was your favorite Inspired Money moment? If we have self-driving cars someday, why couldn't a computer manage our money? I like what Rob said about it not being an active versus passive investing debate. Rather, we can benefit by active and passive investing. With artificial intelligence, it's still early. We have to keep our eyes open to new opportunities in ways that AI will transform the asset management industry. We're going to see how and in what areas machines can do better to assist humans with our money. I'm not ready to have Skynet manage all of my retirement savings, though. I've seen the Terminator movies. If you had a different favorite Inspired Money moment, please post a comment or share it in the Inspired Moneymakers Facebook group at inspiredmoney.fm/Facebook. Thank you for tuning in to the end. Be sure to subscribe to my email that goes out every 2 weeks. It's investment focused, and the Runnymede investment team highlights data, news, and events that we think are worth sharing. Subscribe at inspiredmoney.fm/newsletter. Thank you for joining me on this mission. Have an inspired week and do something that scares you, because that's where the magic happens.